All right, let's dive right in. The 2025 and 2026 tax seasons, they are going to be a critical, and I mean final, opportunity for your clients who are claiming residential energy credits. Why? Because new legislation and much stricter IRS rules have completely changed the game. So in this explainer, we're going to do a really granular, technical deep dive into Form 5695, all to build a definitive audit defense strategy for your practice. And this slide really says it all. While the Inflation Reduction Act seemed to give us a nice, long runway for these credits, some later legislation basically just slammed on the brakes. The 2025 tax year is it. It's the absolute last chance for taxpayers to claim them. And you know what that means, right? It means the IRS is going to be scrutinizing these final year filings with an intensity we probably haven't seen before. We are truly in a terminal environment for these credits. So to get through all this complexity, we've laid out a really clear roadmap for you. First, we're going to start by understanding the legislative cliff that created this whole situation. Then we'll get into the nitty-gritty of IRC Section 25C and the brand new QMIDE regime. After that, we'll pivot over to audits and Section 25D, break down Form 5695 line by line, and then wrap it all up with an actionable audit defense playbook you can use. So what caused this massive shift? Well, it really all comes down to a single piece of legislation, the One Big Beautiful Bill Act, or OBBA. It was enacted as Public Law 11921, and while its goal was broad tax reform, a key piece of it was clawing back unspent green energy incentives. In doing so, it just fundamentally took apart the long-term plan for these residential credits. And this timeline, man, it just perfectly captures that sudden stop. We went from the IRA extending these credits all the way out to 2032 to hitting a legislative brick wall on December 31st, 2025. This abrupt end is exactly why the IRS is going to pour a ton of resources into examining these final claims filed during that 2026 tax season. Okay, you really need to pay close attention to the specific legal triggers on this table. For the Section 25C credit, the key phrase is when property is placed in service. But for the Section 25D credit, it's when expenditures are made. Now, this isn't just semantics. This is a hugely important distinction that impacts timing and what you need to prove in an audit. Getting this right is absolutely critical. All right, let's roll up our sleeves and drill down into the core mechanics of that first major credit. IRC Section 25C, the Energy Efficient Home Improvement Credit. Honestly, this is where so many of the new complexities and audit risks are hiding. So you see this number, $3,200, and you might think, great, that's the max. But hold on. While it is the maximum annual credit a taxpayer can claim under Section 25C, it is definitely not a simple calculation. You can't just take 30% of total expenses and call it a day. The law is way more nuanced than that. And here's where that nuance comes in. IRC Section 25C(b) creates what's called a bifurcated annual limitation. It's a two-part limit. So within that big $3,200 overall cap, there's a totally separate, mathematically rigid $1,200 sublimit that applies just to things like windows, doors, insulation, and home energy audits. These are two independent caps that you have to calculate separately on Form 5695. Here is another huge tripwire for IRS adjustments. The law is very specific about how labor costs are treated. For what's called residential energy property, think heat pumps, water heaters, the labor for on-site prep and installation is fully included. But, and this is a big but, for the building envelope components like windows and doors, labor costs are explicitly excluded. Including them is an immediate red flag for an audit. Okay, now let's cover what is probably the most significant procedural change for the 2025 tax year, the new QMID and PIN regime. You can think of this system as a mandatory gatekeeper for even being able to claim the Section 25C credit. So the first piece of this is the QMID, or Qualified Manufacturer Identification Number. It's just a 4-character code that the IRS assigns to manufacturers who register with them. For your client, this little code is the essential link on Form 5695 that proves the product came from an IRS-recognized source. The second part is the PIN, or Product Identification Number. The taxpayer has to put this unique number on their return. Now, the implication of this is profound. This provides item-level verification. Form 5695 is no longer just a trust me form. It's now a verifiable database that links a taxpayer's claim directly to a specific item from a manufacturer's production log.
And this just shows you what's happening on the manufacturer's side of things. Under Revenue Procedure 2024-31, they have to register through the IRS's online portal, assign a unique PIN to every single qualifying item, physically stick a label on it, and then submit ongoing reports. Here's the critical part for you. If you fail to put that manufacturer's QMAD on Form 5695, the credit will be automatically disallowed, period. Okay, let's switch gears and pivot to two other critical areas that have their own distinct set of rules: how to substantiate home energy audits and how to navigate the very different world of IRC Section 25D. For home energy audits, the number you have to remember is $150. That's it. It's a rigid annual statutory cap for the credit under IRC Section 25C(b)(6)(a). Now, it's a small amount, I know, but because of that, the IRS has put in some very strict documentation requirements to prevent fraud. So to make that little $150 credit completely audit-proof, you have to physically examine your client's written report. IRS Notice 2023-59 says it must contain these 4 specific data points: the auditor's name, their tax ID number, a statement saying they're certified, and the exact name of that program. You don't file this report with the return, but it is the only thing the IRS will accept as proof in an audit. Now, let's talk about IRC Section 25D. This is the Residential Clean Energy Credit for things like solar panels, wind, and geothermal. Its design is fundamentally different from 25C. With just one exception for fuel cell property, there's no annual or a lifetime dollar limitation. A taxpayer can claim 30% of their total qualified costs, no matter how big the project is. And this right here, this is a massive point of reassurance. Even though no new credits can be created after 2025, any unused Section 25D credit from an installation that was completed on time can be carried forward. This analysis from the Congressional Research Service confirms it. That carryforward becomes a legally protected tax asset that survives even after the credit program itself is gone. Okay, so with all that context, we can finally look at the form itself. Properly filling out the 2025 Form 5695 is really the final gauntlet, where all of these complicated rules finally come together. But before we even get to the line numbers, we have to talk about this. This is so important. According to IRS Announcement 2024-19, any point-of-sale rebates from a state are treated as a purchase price reduction. It's not income. So what that means is you must subtract the rebate amount from the cost of the property before you calculate the 30% federal credit. It's a critical basis reduction calculation you can't miss. So here's the flow for that Section 25D credit in Part 1. Step 1, on line 12, you capture any carry forward from 2024. Step 2, line 14, calculates the tax liability cap, and that's determined after all your other non-refundable credits. Then finally, and most importantly, line 16 is where you compute the final amount that can be carried forward. That number on that line establishes that protected tax asset that your client can use in 2026 and beyond. We've covered the law, we've gone through the limitations and the mechanics of the form, so now let's just distill all of this down into a powerful, actionable summary, your Audit Defense Playbook. This is the solution to the problem of that intense IRS scrutiny we talked about. Here are your non-negotiables before you file. You absolutely must obtain and verify that 4-character QMID. You must secure and review the signed, compliant written report for any home energy audit. You have to rigorously confirm and subtract all those state rebates from the cost basis, and you must meticulously calculate the Section 25D carry forward on line 16. This isn't just best practice anymore. For this final year, it's mandatory for audit defense. You know, this quote really says it all, doesn't it? The era of just accepting a generalized invoice from a contractor, that's over. In this final year for the credit, the only way to protect your clients was methodical, granular documentation that is aligned directly with all of these complex rules we've covered. So the critical question I have to leave you with is this: are your internal processes ready for this new level of scrutiny?